If a stock has negative EPS, negative revenue, and reverse splits, it's not an investment, it's a donation. So the first thing you need to ask yourself before you make an investment, will the revenue continue to grow? Is EPS growing or stabilizing? Earning reports good or deteriorating? BINI was worth over $471 trillion and now it's sitting at 6 cents right now. But check this out, it keep reverse splitting, it keep diluting its shares. TradingView, if TradingView is too advanced, use Simply Wall Street. Simply Wall Street is going to be the easiest. If a stock has negative EPS, negative revenue, and reverse splits, it's not an investment, it's a donation. Today I'm going to show you the difference from investing in a good company and how to not donate in a trash company. All the websites I'm using today are beginner friendly. All of them you can use on your phone. If you got a laptop, it's better to use them on a laptop. Right now, I'm gonna shout out all the platforms I'm gonna be using to help all the beginners see in a simple and easy way, how can you tell if a company is glad or trash? First thing first, we need to use TradingView. Either download it on your phone or look it up on your website. Then we have Simply Wall Street right here. And we got Yahoo Finance. And then what you wanna do is, any stock you like, you want to type in the ticker symbol and just type in investor relations afterwards, like this, ADB investor relations. Click on that. You can pull it up on your phone, but a laptop screen is way better. That's why I'm using my laptop. And boom, you're going to see it. What is Adobe? Adobe is one of the largest, most diversified software companies in the world. Check out the disciplined diamond hands investing backdrop. The cons is it takes $1, but the pros is it builds wealth passively. It creates a passive income stream. There's no physical labor needed. It erases the wealth gap, no cap on salary. Why miss out on all those pros by focusing on the con of it takes $1? All right, so first thing first, the EPS tells you how much money the company makes per share. First thing you need to ask yourself before you make an investment is, will the revenue continue to grow? If you're buying an ETF, of course the revenue will continue to grow, because if you're buying SPY or QQQ or a large holding ETF that has been performing historically, of course it's going to be profitable because all it invests in is profitable companies. So if you're investing in an ETF, you get to X out a lot of these questions because the ETF will control all of this for you. All you have to do is buy a good ETF like SPY. So the first thing you need to ask yourself before you make an investment in a single company is, will the revenue continue to grow? Is EPS growing or stabilizing? Are there any reverse splits? Are earning reports good or deteriorating? And is the business model / company broken? Today I'm gonna go over all these questions for you real quick, simple and an easy fashion that every beginner will get to see from a beginner's viewpoint. You feel me? So first thing first, how can we tell if a company revenue is growing strongly? The first company on the list is Adobe. What does Adobe do? Well, let's go to TradingView and scroll at the bottom. It engages in the provision of digital marketing and media solutions. I use Adobe for, Photoshop, editing, stuff of that nature, for digital media. It's bringing in revenue from a lot of different segments, from digital media, digital experience, publishing, and advertising. Not only that, the digital experience segment focuses on integrated platforms and products, services, and solutions that enable businesses to create, manage, execute, measure, monetize, and optimize customer experiences that span from analytics to commerce. So check this out. How can we tell if their revenue is growing? Well, let's go to TradingView and scroll down to their income statement. Look, in 2021, they was making $15.8 billion. Now their revenue is sitting at close to $24 billion. Not only that, we can see that they fell very hard. They became oversold right here once they touched down at 335. A lot of people may believe that Adobe is a failing company and that will continuously fall like some of these stocks on the list, but I believe otherwise because their EPS is continuously rising. They're continuously beating their expectations. Look at their earnings streak. The last time they lost on earnings was back in 2018. So this is a phenomenal company financial wise, and their fundamentals keep growing. So yes, their recurring revenue is consistently growing up. Their net margin is 30%, is very great. They're dominant in their creative software industry. Their EPS is positively growing. The lower they fall, the more they're going to take off once smart money and demand really picks up. And demand may pick up once it dipped below 300. What we're going to use now, we're going to use Simply Wall Street, because Simply Wall Street will tell us a lot of what we have saw on the last screen. Simply Wall Street will help a lot of beginners out because it's simple. You can see the value of it. You can see the past, you can see the health. You can also see the rewards of investing in Adobe. It's trading 34% below their estimated fair value. Earnings are forecast to grow 7%. Earnings grew by 28% over the past years, trading at a good value compared to peers. What do analysts estimate Adobe to be worth? Wolf Research price target is $440. Deutsche Bank estimated them to be worth around $475. Barclays expecting them to be around $465. So we can see all this information on Yahoo Finance. The analyst price target average is $431, and they're sitting at $355 right now with growing revenue and growing EPS. Let's check out their earnings report. In fiscal year 2025, they had continued growth of Acrobat Web, which saw a monthly active user increase of over 30% year over year. So their platforms are growing. Strong adoption of Express in education with over 70% year over year growth of students with access to Access Premium. Over 45 new partners added to the Express ecosystem in Q4. Over 25,000 businesses purchased Express or Studio for the first time in Q4 alone. So they're getting thousands and thousands of new customers, and their revenue is growing by the billions, and their EPS is consistently growing while their price is continuously falling, and while analysts is still expecting them to be worth more than their current share price. We can check out some of these companies that are doing terrible, like BINI. Here's a simple way to check out BINI and see if it's a good investment or a trash investment. BINI was worth over $471 trillion, and now it's sitting at 6 cents right now. But check this out. It keep reverse splitting and it keep diluting its shares. The shares of this company is becoming more worthless every time they split, and the company is becoming more worthless day by day because it's artificially raising the price. Healthy companies don't need to reverse split. Their net margins are also negative. Let's check out their net margins on TradingView. Look, their net margin is negative 42,000%. It was negative 266,000%. Their revenue is not increasing year over year. Let's see what Simply Wall Street believes BINI could potentially do. Simply Wall Street believes BINI is worthless and it's just a trash donation if you give money to them. Look, earnings have declined 25%, negative shareholder equity. It's just diluting their shares. It has no future, it has no value, no dividend, no health, or no path. Let's go look at FISV. FISV has failed to hell, I ain't gonna lie. But they oversold on the weekly time frame. This is the lowest they ever been on the weekly time frame. I actually started putting some cheese in them. I'm up on them by a couple percent right now, but I'm holding till they get 100 plus basically. FISV last earning reports is great. I know they miss earnings, but they have great guidance. Not only that, their revenue is increasing year over year. Their net margin is increasing year over year. The future really looks up for them. They're below intrinsic value and below the fair value that a lot of analysts expect them to be below. And we're going to check that out. Their cash flow, look at their operating income. It's steadily increasing year over year, the same way Adobe's is consistently increasing year over year. See, all you really need is TradingView. TradingView, you will be able to see a lot. But if you're a beginner, just download Simply Wall Street on your phone. Simply Wall Street is about to tell you a lot of great things about FISV that we already saw looking at TradingView. FISV is one of the biggest fintech companies globally, but check this out. They're trading at 50% below their estimated fair value. Earnings grew by 18% over the past years, trading at a good value compared to their peers in industry. Let's go to Yahoo Finance. Get Yahoo Finance on your phone and look up the stocks that you're invested in, and you'll get to see what other analysts believe about them, and you'll get to see the most current events and news about them as well. Let's check out FISV. Let's go to Analyst right here, and then we're going to hit Analyst Insight. Let's see what the analysts believe. Well, analyst price targets, the average is $95. The high is $250. So hey, I hope they'll go back to $250 because I'm in them right now around $60. And let's check out their earnings report real fast. Adjusted revenue is up 1%, up 5% year to date. Cool. Organic revenue growth is up 1%. Cool. They took a big hit, but a lot of their numbers are still up. Free cash flow of $1.3 billion. They repurchased 7.2 million shares in the quarter, returning $1 billion to shareholders. They got that free cash flow for sure. They issued 5-year and 10-year senior notes at 4.9%. Yeah, if your account's not getting anything above 4.9%, you need to go get SPY ETFs and you need to go get some FISV bank notes. Check this out. They announced strategic acquisitions, expanding capabilities in deposits, stablecoin, advisory services, the Clover VAS offerings with Stone Castle, Smith Consulting. They signed an agreement with top local financial partners to launch our leading integrated POS solutions for small business owners in Japan. So they're networking with small business owners in Japan now. Not only that, they signed managed services agreement with TD Bank Merchant Solutions, expanding Clover footprint in Canada. So they're expanding into multiple countries. Not only that, their revenue has been backing it up and showing that they consistently can bring in that revenue and that cheese. When we check out a company like Burrow share price was once $560. They did a reverse split of 40. Let's do some math real quick. A lot of companies do reverse split so they don't get delisted. They have a trash company. They need to up their share price. So a lot of them up their share price by doing a reverse split. Because imagine this, okay, share price is below 50 cents. Well, if they do a reverse split, the price of it will go up to $20 just by doing a reverse split, diluting the shares. Let's check out their margins and revenue, things of that nature. Net margin, almost negative 1,000%. Almost negative 1,000% in 2022 and 2023. In 2024, their net margin was negative 23,000%. So their net margin is going to the trash. This is how you donate to trash companies. You give someone your money that's bringing in a negative 23,000% net margin with no sight of increasing that net margin at all. See, some companies are in great fields, but it's just a trash company with terrible leaders. So that's why you also got to analyze what kind of leadership they have. Because when you're making an investment, you're really investing into the CEO and what the CEO believes and what the CEO can do for the future. Because if it's a terrible CEO that can't manage nothing at all, can't even manage the company, it's going to give you results like this. It's going to fall from 560 all the way down to 20 cents. Let's see what Simply Wall Street believes in this company as well. Boom, volatile share price, market less than 1 billion. Earnings have declined by 34% per year over the past 5 years. Shareholders have substantially diluted in the past years. Look, no future, no value, no dividend, no health, no past. Straight trash. We also have another trash company right here, VYST. They did a reverse split for 100. So once their share price fell below $1, they did that 0.50 times 100 just to bring their shares back up to $50, and then it keeps tanking. It's just going to keep tanking. It was once worth $24,500, now it's down here to 6 cents, and it just keeps tanking. Then we got BELR. They also diluted their shares and did a reverse split by turning 100 shares into one. So this is the easiest and most beginner-friendly way to see if a company is trash or glad. Use TradingView. If TradingView is too advanced, use Simply Wall Street. Simply Wall Street is going to be the easiest and the freest platform to use. If you want to level up from Simply Wall Street, then use Yahoo Finance. Yahoo Finance will give you a lot of news and a lot of analysts insight. Reviewing their earnings report will give you a lot of news and insight into what the company is doing to grow for the future, which Adobe is doing a lot of things to grow for the future, as well as FISV is doing a lot of things to grow to be one of the top fintech companies in the world. The main things you need to check for before you single-handedly invest in a company besides investing in an ETF. ETF is the easiest thing to invest in, hands down, because they will manage the fund to where the fund will invest in companies with growing revenue, with a growing EPS, that aren't doing reverse splits, that have good earnings report, and that has solid fundamental business models and companies. ETFs will automatically manage those funds for you. But if you're single-handedly going to invest in a stock for yourself, then you want to use tools like Simply Wall Street, Yahoo Finance, and TradingView to make sure you're not getting something that's trash. When you're buying on a dip, you want to make sure the company is still fundamentally sound and proven, and not like any of these companies that will have to reverse split, that don't have great fundamental reports out, that aren't financially stable, and that are losing money with negative 24,000 net margins.